welcome to Property Thursday. Andy and Johnny probably do the best webinars, and that's why I'm really, really excited about this one. And I know we've got new starters on here, and we've got people that are tried and trusted property sales guys, but please get those questions coming in at the bottom, because we love to make it interactive. We do not want a slideshow, we want to make it interactive. So welcome again, Andy. Thanks very much for jumping on.
Thanks for having us, Chris.
Marks and Spencer sweater. And Johnny, of course, you look after the Middle East, and you're ever in the office, which is great. So I'm going to pass you straight across to you, Andy. Over to you.
Thanks very much, Chris. And yeah, it is April Fool's Day, so I thought I'd do something a bit different today. Welcome, everybody. Thanks for coming on. As Chris said, let's try and make this as interactive as possible. Please send in your questions. We can see them at the bottom of the screen. Make them as hard or as simple as you like. Because the idea of this is you don't just want to hear me and Johnny going on and on. You want to get something out of it. We want you to have take away some really important points that you pick up, that you learn, that you can use and make informed decisions if you're thinking about investing in property. So let's crack on. We'll try and keep it down to 35, 40 minutes and keep it interesting. So let's crack on. First one then, please, Chloe. So yeah, this is me, Johnny and Chris. Next one. Right, so today, the UK market in 2021 and beyond. We're going to cut through all the jargon and all the kind of hype. Expert tips on property investments. Expert, it's just an opinion. Who really is an expert? Listen to me, see what you think. You can disagree with me, agree with me. Johnny will tell us all about an investment opportunity we've got in Bracknell and why we chose there. And then we'll do that Q&A at the end. So don't forget your questions. Right, next one. And next one. Right, here we go. Prices to rise in 2021. This always kind of makes me look at this half-heartedly, because these are the PLCs. These are people we all respect, you know, Rightmove, Knight Frank, Zoopla, Savills, and they're telling us about the prices are going to go up. Look, here's the thing. With the cost of buying property these days, stamp duty, etc., mortgage fees, legal fees, you don't want to be getting in for just a year or two, because if you buy today and sell next year, you are going to lose money. The days of buying something for 200 grand and in a year it goes up by 50,000, those days have gone. It's a much more mature market now in the UK, and the beauty of buying property in the UK is long term. It's about creating wealth for the future, your pension planning, and the difference between property and stock market is you can leverage. What does that mean? You can borrow, you can have mortgage. You can't borrow to go in the stock market. You can't get a mortgage for the stock market, but in property you can. So you can borrow, you can buy a property for 200,000, put 50 down, borrow 150, and the thing doubles in value over a period of time. Now, we don't know how long that is. We can look at the history. It could be 15, 20 years, but you're not worried about this increase 4% or 1.5%. I know we have to have one eye on what about if my circumstances change and I get out, but you'll go crazy trying to time the market. It's not timing the market, it's time in the market. Right, next one. This is the history. So this goes back 1977. What's that? 23, 44 years this goes back. Look at what happened back in the day. Our parents, they made a fortune. If only this could have been us today, the baby boomers. So look, it doubled. Prices in the UK doubled 5 years, 6 years. Imagine if that was today. The last two doubles have been 13 and 14. So if you said to me, Andy, how long do you think it's going to take for him to double? I'd go, well, you've got to look at about 20 years. But even after 15 years, it's going to have gone up quite a bit. But the peaks and troughs come when we don't expect them. Pandemic, financial crash. You've just got to get in and stay in for a long time. Next one. Brexit on the horizon. God, we haven't heard that one for a bit, have we? The old Brexit. This is talking about uncertainty, this first. You've got three black squares here. The first one is about uncertainty. Certain areas of the market flourished at the start of 2020, Brexit, blah, blah. I mean, Brexit's kind of been and gone. I think all I can say about Brexit is that there was uncertainty for 3 or 4 years, and that's now gone. As far as the property market and prices are concerned. Life after lockdown, this is an interesting one. what's going to happen? Is everybody going to work from home in the future? Is everybody going to, do they want gardens now? They don't want apartments, etc., etc. Well, again, it's just an opinion. What we've seen, what the PLCs, like Frank Savills, are reporting is that the home counties, the commuter belt from London, Canary Wharf, right in the city, they're getting a lot of inquiries now. People are looking to move out from a £750,000 flat in, I don't know, Camden or Canary Wharf and move to Bracknell or Basingstoke or Slough for a 400,000, half the price. It's just 15 minutes into town, and they probably won't be going into the office every day, but who knows? Who knows where all this is going to go? I think we'd all agree that there's probably going to be some legacy after the pandemic where people are going to work smarter. But the one thing a lot of people forget is culture. Culture eats strategy for breakfast. It doesn't matter how good your team are. If you haven't got the right culture, they're not going to perform. And in particular, sales and marketing operations, they need to be together. They need to get inspired by each other and get that culture. So let's see, there might be a shift away, but I can see it all going back to normal, especially with the bars and restaurants that have been closed in the towns and cities. They make it somewhere that, in particular, the youngsters want to live, the young professionals. And so let's see how it all ends. Nobody knows. And then the last one, coronavirus unmasked. I think I've just copied that one. Property prices skyrocketed 7.3%. Yeah, that's just talking about prices now, what's happening in the market. There was an unusual thing that happened. We had the lockdown in the UK, and it kind of came back in June, July. And to support the market, Rishi Sunak, the Chancellor, said, right, we're going to give you a holiday on stamp duty. And it caused like a mini boom. And so people couldn't understand it, mass unemployment, job loss, uncertainty. Why are the prices going up? Well, it wasn't apartments in city centres. It's the houses. It's people looking to move house and say it's the local market. It's not the investor buy-to-let market. The thing that's important to us as apartments in towns and cities, we're looking for the tenants. We're looking for young professionals, sustainable young professionals. The fact that the housing market is going up and down doesn't really affect us going forward. So it's not really, that corona unmasking isn't really relevant to us. Keep your questions coming in, guys. Next one, Chloe. Yeah, who's an expert? Maybe I'm not an expert, but I've just been doing it for a long time. Next one. We're in the hands of the letting agents. Yeah, this is a good one. A lot of people don't know this. Right, I bought my first property when I was like 25 and I'm 57 now, so a long time ago. Now, this is what you don't realise. You need that property rented, not just next year, but you need it rented for the next 20 years. I've still got that property. I bought it for 110 grand and it's 325 grand now. It went up, down, up, down, up. Over the years, you're going to be okay. But what you don't realise is what happens. What happens when your tenant leaves and the next one comes? Well, what happens is the guy from Newcastle gets a job in Birmingham, for example, and he's got to find a place to live. So what does he do? He goes on Google and he finds 5, 6 letting agents. He calls one up. Hi, got a job working for Marks and Spencer's in Birmingham. I need somewhere to live. Now that letting agent has got to get that tenant because he's worth £2,000 to the letting agent. He's going to get about £750 for finding the tenant, because that's what it costs when they do all the legal searches and make sure the tenant's proper and he's going to pay. And then they're also going to get about £1,200 for the management fee. So it's £1,000 a month to rent. I'm going to charge 10% as the managed letting agent. So there's £100 a month, 1,200, 7. He's worth £2,000 a month. I've got to get this guy. I know it's competitive and I don't want him to go somewhere else. So that letting agent will make it his business to know where all the best apartments are. And so we've got to make sure that whatever we buy, whatever we invest in, the letting agent will love that apartment and want to promote that apartment because of the location, because of the amenities, because of the style, the quality, etc. So this is what we have to have one eye on sustainable tenant demand and making sure we please the letting agents, and our product will help him to sell it and make his money. I Ding.
And Andy,
Yeah, go on.
you touched on it, and somebody's written a question, and you touched on it, a property, and we're talking about new apartments and Bracknell, Slough, etc. Doesn't matter where. But you got experience of a house. I think when you first started off, you thought, oh, a house is the way to go. And I actually had a client yesterday who phoned me and said, no, he wants a 2-bedroom house, not a 2-bedroom apartment. What would you say about that?
Brilliant question. This was me. Chris. After I bought my first few apartments as a youngster, I got fed up with paying the service charge. You know, £200 a month, £2.5 grand a year, plus the ground rent. You know, £100 a month. And I thought, God, I'm just not enjoying this. I used to have to pay it 6 months in advance. It's a lot of money. And so I thought, I know, I'm going to get a house. No freehold, no charges. Anyway, what I learned in a nutshell is this. You pay the same because you've got to maintain the house. You know, the fence comes down, the garden, or the roof leaks, or whatever, the windows, the washing machine. But the difference is between apartments and service charge and houses and freehold is when you're the landlord, you're responsible for both. But on the apartment, you pay 200 quid a month. And so it's done for you. There's a property management agent, and they organise all that for you. You just pay a monthly fee. Whereas when you're the landlord and it's a freehold property, the tenant rings you up and says that the roof's leaking. You've got to organise it yourself, and you don't pay anything for a year. You may go 2 years and pay nothing, but then you've got a £5,000 bill. And the other way with the apartment, you still pay £5,000 over 2 years, but you pay £200 a month, and you don't have to get involved. And that was my experience, Chris. I'm sure other people have got different experiences, but I decided to move away from houses and freehold property then, just for apartments.
Thank you.
Okay. Next one. Yeah, this is the old adage. We all know this one. To do with tenant demand, to do with that letting agent scenario we just told you about. You've got to buy in the right location. Why? Why location? Well, because it's got to be where people want to live. What's happening around the world, not just in the UK now, is people are migrating towards the towns and cities. The towns and cities used to be just for shopping, banking, and that was it. Nobody lived in the towns or cities. Now the retail part of the world is changing. It's all online. The high street is diminishing. We're seeing this all the time. And what's on the up is residential, leisure, bars, restaurants, theatres, etc., and also commercial, the world of work, offices. So the millennials, the digital natives, as we call them, people born with a mobile phone in their hand, the young professionals, they want to live and work in the town. They think only a dinosaur would sit in the traffic every morning for an hour or two, or commute for an hour on the train. They want organic food, they want a gym, they want to walk to work. These young millennials, young professionals, if you're an accountant, architect, lawyer, solicitor, doctor, whatever, you want to be on that scene. You want to be in the bars and the restaurants. So you work for KPMG, and actually I want to mix with the guys from Deloitte and PwC, because my next move is going to be there. I'm 21, I'm a graduate. When I'm 25, I'm going to move there. And they want to be in the mix. And we lose those tenants when they're kind of 30 plus, mid 30s, because then they want to get married and have a kid and get a garden and what have you. But certainly the demand for city centre and town centre living all around the world is increasing. And it's because of social media, and the kids who lived on the farms, and the bus comes every Wednesday, they can see what's going on. They never used to see it before. They can now see what's going on in the towns, and they want the action. This research is from the government, it's from Knight Frank, JLL. This was done 10 years ago, and we're seeing the towns and cities become more and more popular. Okay, next one. Don't try and time the market. We talked about this before. You'll go crazy trying to time the market. I'll wait next year. I'll wait next year. The only thing I can tell you about this, guys, is it doesn't matter if you buy at the top or buy at the bottom. If your plan is like me, you want this to double in value. You want it to be your pension when you're 65. It doesn't matter if you're getting at the top or the bottom. I bought my property. Chris knows this story. I bought my first one at 110 grand. My mate bought the same apartment next door for 88,000. It went up 22. They put it up 25% in the second phase. And I couldn't live with it. And anyway, I bought it. And of course, now it's 325,000. I'm not bothered about the 88 or the 110. If it's going to double in value and you're going to keep it, the time for you is when you've got the money. If you find yourself in a position where you've got a bonus or you've saved or however it's working, you've got cash, that is the time to get involved. Just make sure you choose the right partner to deal with if you're going to buy off plan, to get in early, so your money's safe, and make sure you get the right location so it's sustainable. And you just let it sit there and cook. When it's ready, when it's built, you just get it furnished, we do all that for you, and then just let it cook, and then just forget about it. When I did those, go on, Chris.
There's a great poster out there that I've seen, which I love, and it just says, the best time to buy a property was 5 years ago.
Yeah, well,
no matter when it was, but it was, wasn't it? You're never going to go wrong. It was 5 years ago was the right time. Today's the right time. Yeah. Absolutely.
The only reason you should be getting involved is to go long term. As I say, the cost to buy now, stamp duty, etc. If you have to look, we don't know what's around the corner. Sometimes you invest and then you've got to sell, and it's just the luck of the draw, basically, and that's just life in general. You should only be getting involved if you're looking for a minimum of 5. And even then, you could be lucky or unlucky. You want to be in for 10, 15, as long as possible. I mean, I've never sold any of my properties that I've bought. I bought them in good locations. There's still tenant demand today. When they're 20 years old, sure, you've got to spend 6-7 grand and have a new kitchen and whatever. But if they're in that right location, there'll always be demand for them.
Andy, you asked people to put pictures, questions up so we can make it interactive. And Keith's come in and said, when you say we let it for you, and I know you have a comment, does the investor get a guarantee? Are there times when the rent won't be collected?
Good question.
I can answer that.
Thanks for that, Keith. Right, guarantees shouldn't exist anymore. I tell you why. Rent guarantees came out before the financial crash. When the mortgage lenders lost their money in 2008, they realised that property prices had been hiked up to give rental guarantees and free discounts and stuff. And so you won't get a mortgage now if somebody offers you a rental guarantee, because the mortgage companies don't allow it. Okay, so beware if you see rental guarantee. What you want to look at is you want to look at the data around that area before you buy, before you invest. Google those letting agents, like I said, pretend you're a tenant and just say, what's the market like? What's the demand like? What's going on in this town? Is there regeneration? Is there job creation? And that's what you want to look at. Because to answer your question, Keith, the one thing we want to avoid as investors is voids. When you've got somebody in your apartment paying £1,000 a month, that pays for your mortgage, pays for the council tax, they pay the bills, etc. When somebody leaves and you don't find a tenant, you have to pay the council tax. It might only be 60 quid or £100 a month, but you've also got to pay the mortgage if you have one. And all of a sudden, from being cash flow positive for, say, £500 a month, you're now £800 a month going out. And if you buy 1, 2, 3, 4, 5, and they all become empty, this is the risk. So, yeah, you've got to avoid voids. And this is why we need sustainable tenant demand. Another part to your question. Oh, yeah, we do help. The reason why we set this business up right at the beginning, Keith, is because I bought a property abroad as a young man. I got some money, I sold a business, and the service was shocking. So I know what people need, especially if you're buying from overseas in the UK. You need a fully managed hands-off service. So when we finish the build and it's ready, we help you get a mortgage, we help you complete, we'll then help you furnish it, and we'll help you choose a letting agent to get it rented. All of that stuff. So the whole thing is done for you. It took me 12 months to get my place abroad furnished, because they just threw the keys at me and it was ready. It went up in value, but it was a long time before I got it ready. So we do all that for you. And any bona fide developer should be offering those services for you. Make it easy. Right, thanks for that, Keith. Keep the questions coming, guys. Next one, Chloe. Yeah, look, this is just going on about don't try and time the market. There's my example bottom right. That was that property I bought. it goes up. In general, again, you can't always say the future is going to be the past, but in general, the cycles are about 10-year cycles. It goes up for 7-8 years, and then it corrects for 2 years, goes up for 7-8, correct. This is what's happened in the last 40-50 years. And so if you try and time that, it just makes sure you know you're in for a long time, and you know that it's going to be sustainable tenant demand. Here we go. We've got another one up here. Is that a question? For cash buyers, this is from Way. Thanks, Way. For cash buyers, do letting agents help international clients open bank accounts in UK? No, not the letting agents, Way. They don't do it, but your lawyer will. Your lawyer or your tax advisor will help you do that. It's important. You do need a UK bank account. It helps you get the mortgage, especially if you're an expat or you're an international buyer. So again, we can help you with all that. It's something that we do all day, every day for the international buyers. Thank you for that. Okay, next one. Sorry about this, Johnny. I'm going on and on. You're sitting there patient. Right. Look, this is an interesting one, guys. How are you going to buy? You're going to have a mortgage. You're going to pay cash. If you're going to have a mortgage, are you going to try and pay the capital off over a 20-year period? Or are you just going to pay interest only? Well, let's have a look at what happens. This is a £200,000 apartment. So if you look at the little, there's 3 examples, one on the left, one in the middle, one on the right. Look at the little box on the left, the little stack, that is £200,000. So this is the apartment at the beginning. And then the taller stack next to it, that's after 20 years or however long it takes for it to double in value. Now, the one on the left-hand side is where you try and pay the loan off. So the first little stack, look, 200,000, you put in the black £50,000 in, that's your deposit, and you're borrowing 150,000. And we're assuming that your income is going to be about 1,000 a month, right? So, and we're saying that your monthly mortgage and service charge and all the bits and bobs, we're saying that it's about 1,250 going out. Now, I've made this up. You can have it where it's level, but let's just look at the worst case scenario. So you've got £1,000 rent coming in, but you've got £1,250 going out because you're paying the mortgage off. It's capital and repayment, not interest only. Now, that means you're underwater. Your P&L, your profit and loss every month, you're losing £250, but you're not really, because you're paying it into your pension pot. You're paying that mortgage off, right? So each year, the cost is £3,000. Because you've paid £250 contribution from your pocket each month. Right, but let's just look what happens when it doubles in value over whatever period that is. When it doubles in value, it goes from 200 to 400. That's the big stack next to it. You've still put your 50 in at the beginning, but you've got £200,000, the big white block as capital growth, and you've paid, well, you haven't, the tenant has paid your mortgage off. And you've got all this 150 grand equity. So after 20 years, you put 50,000 in, plus your 3,000 a month, which is like a pension contribution, but you've got £400,000 completely unencumbered. That means no loan on it, asset. Now imagine if you bought one a year. So you know, if you invest 50k a year each year, and in 20 years' time they all double in value, and you pay the mortgage off, yeah, there's £2 million for your pension. The only problem is you paying the 3,000 a year. You've got to have lots of cash around you to take this strategy. It's the most rewarding at the end, but you are paying £3,000 a year. Now, if you get 5 properties, you're paying 15,000 a year, and that's if they rent all the time. What about if there's a void because there's a pandemic or something? So only do the one on the left. It's the one that gives you the most return, but only do that one if you've got plenty of cash around you, cash rich. The middle one, this is 90% of what investors do. This is a halfway house. This is where you don't pay the mortgage off. It's just interest only. So if you look at the little numbers, your outgoings are only £600 because your mortgage is half the price because you're not paying the capital off. You've still got the 1,000 coming in, but you're now making £400 a month cash flow positive. So at the end of the year, you've got 4,800 sitting in there. Now, what could we use that for? Well, let's just say there's a void period. Let's just say you have a leak and it takes you 3 months to get it all dried out and blah, blah, blah. This is doing it in a safer way. You could buy one a year for 5 years with this strategy, and you're not so much worried about being underwater financially each month. Now, what happens at the end on this one? Look, same on the left, the little stack, 200,000, 50 deposit and a loan of 150. On the right, the big white block, you've made your 200,000, it's doubled in value. This is in 20 years' time. You've still got your 50 in there, but you've still got the loan because you're just paying the interest each month. So you've now got, what, 250,000 equity in there. So if you get one a year, you got 1.25 million. You haven't got 2 million, but you haven't taken the risk. And so this is the most favorable route to take. And on the right, this is if you're a cash buyer, you've got plenty of cash for whatever reason, and you don't need to leverage. And what you do here is you take all your income now, because you just buying your apartment for 200,000, and whatever the rent is, you've only got your service charge and your ground rent. So look, your outgoings are £200, 1,000 coming in. So you've got 9,600 a year coming in. If you get 5 of them, you've got 50,000 a year coming in as an income. And of course, you're getting on paper your capital growth. If you kept it a long time to pass it on to the kids, you're building up a nice portfolio there. Right, next one. I hope I'm not going on, guys. What's this? Don't lose your money. Right, this is just a basic one. 95% of people out there selling UK property off plan are not developers. They're not builders. They're not developers. They don't own it. They are agents. There's some bona fide people. We all hear of the PLC agents, Knight Frank, Savills, JLL. They are trustworthy companies. You can trust those guys. But I'm not talking about those kind of agents. I'm talking about the property agents who haven't got a particularly good track record. They haven't got any control over the product, over the timing, over the quality, over actually does somebody go bust, etc. So if you're going to buy off plan and put your £50,000 down, choose the right partner. Go with a bona fide developer who's got a track record. You've got developers out there in the UK like Berkeley Homes, Galliard Homes. Hopefully you feel the same way. SevenCapital are like that, where they've delivered 30, 40 developments, hundreds, billions of pounds worth of property, and they've got a good track record. And you can go and see what they've done in the past. You can ask them to show you. So yeah, that's what it's all about. The questions to ask the developer, how much experience have the company got? What's the past performance? Do you own the land? Have you got planning? Have you got funding? The warranty, there should be a 10-year bill warranty. A lot of the agents don't put this in place until right at the end, and you're exposed and so on. So choose the right partner. Next one. Invest, and it's over to you, Johnny.
Wow, thanks, Andy. You sure you don't want to carry on?
I'm just conscious that, sometimes we go on, don't we?
You do, yeah.
Yeah, I know I do. I know.
Right. Hi, everyone. Thanks, Andy. Thanks, Chris. Yeah, if we go to the next slide, please, Chloe. I guess leading on from what Andy's just been speaking about, choosing the right developer. In a nutshell, for those of you that don't know who SevenCapital are, obviously we've established we're a developer. We've been around for 12 years, and over that 12-year period, we've built over £2 billion worth of property around the UK. So when Andy talks about choosing a developer with a track record and a history, that's exactly what we have. We've built over 6,500 units already that are actually complete, and we've got another £700 million worth of property that's actually under construction. So proven track record as a developer with over a decade worth of experience. But where do we buy? And remember that we're talking about investment property here. So we want to look at locations whereby we perceive that we're obviously going to achieve substantial capital growth and also continually rent the property and obtain a decent rental yield that's going to offset your leverage if that's the route you're taking. So that's where SevenCapital have been successful over that decade, is choosing the right locations to build. So look, there's various different locations which we have built and which we are going to be building. For the sake of time, I'm going to just touch on one. But there's a lot of parallels between obviously the properties that we build in the different locations. So if we go to the next slide, please, Chloe. So Bracknell, and again, please. So for those of you that don't know Bracknell, Bracknell is, and I think we come onto it on the next slide, it's to the west of London. It is 20 minutes away from Heathrow. It is 5 minutes from Ascot, which many of you might know from the horse races. So a nice affluent area of the country. But Bracknell, the real story and the reason that we've committed there twice actually as a developer, we've got 2 developments there, is because of the names that you see on the screen in front of you now. These are some of the biggest companies, blue chip tech companies in the world. Fujitsu, Oracle, you've got General Electric, HP, Microsoft. All of these businesses are today based in and around Bracknell. So this isn't talking about the future, what might happen. This is commercial commitment that already exists in the center of the town. So that's huge. Bracknell, for those of you again that don't know, is a population of 120,000. It's a small town. So to get this huge commitment from these tech companies is big news. And so obviously with that comes opportunity in what we do and from the residential side. Not only this, but what we're talking about in Bracknell now, and Andy mentioned regeneration areas, which is where we focus. Bracknell has achieved £770 million worth of investment that is going to span out over the next 12 years. So that's a huge amount of money to go into a town that is of population 120,000 people. And the reason that they're doing it, this money, by the way, is coming from Schroeder UK and Legal in General. The reason that they're providing these funds is because of this commercial commitment. And what do we want Bracknell to be? A place that you can work and then go elsewhere to live? No, we want to make it a place that you can work and also live. So that's what's changing in Bracknell. And that's where we come in from the residential side, is offering that property that doesn't currently exist in the town.
Johnny, can I just add that I'm actually from Fleet in Hampshire. It was just on your map earlier on, which is obviously about 20 minutes from Bracknell, from Slough, from Basingstoke. There was nothing when I was in England happening in Bracknell. And going back to Andy's, but it's all about timing. It's unbelievable looking at those names. I think Oracle were there, funny enough. I had clients in Oracle, but those other companies just weren't there. And you wouldn't have ever dreamt that a place like Bracknell could become such a hub. And 30 minutes, is it 30 minutes into central London with and you're on between the M3, the M4, you can get down to the coast if you want. I mean, it's a great location.
Yeah, it's 50 minutes direct train to Paddington, but with Crossrail coming in, you can go to Reading and then into London in 30 minutes. So yeah, it's a good location. And as I say, the big emphasis behind it is the fact that you've got this commercial commitment. I mean, there's a quote at the top from Boris Johnson, which is slightly tongue in cheek, as a lot of what he says is recently. But he said at the beginning of last year that Bracknell would become the epicenter of global free trade post-Brexit. As I say, slightly tongue in cheek, but the reason it's getting that exposure and even the mention is because of this commitment from businesses to that town and to the areas surrounding it. Next slide, please. So yeah, so again, to talk about the location, 20 minutes to Reading, as I say, which will provide a quicker route into London at the end of the year with Crossrail, 50 minutes into Paddington today. So you're less than an hour into central London. Anywhere in the UK that is less than an hour commute into London is deemed a commuter town. So is that the reason that you invest into Bracknell? No, that's probably the previous slide. But is it going to be something that benefits your asset and your investment? Absolutely. Anywhere with that vicinity to London is always going to have an appeal. And it's worth mentioning as well, I mentioned Ascot being 5 minutes away, Windsor 20 minutes away. This is an affluent and sort of higher class demographic of the UK. Bracknell was slightly left behind to that regard. It didn't have any exposure. It didn't have any investment. It was kind of left behind. But what they're trying to do now, which I'll come on to, is reciprocate the image that these other surrounding towns have. And that's what they're achieving. So location wise, again, very strong, connected to the rest of the country, close to Heathrow, close to Reading, and less than an hour into central London. Next slide, please. So the regeneration I talked about there, you see it, the £770 million. What you see on your screen here are real photos of something called the Lexicon Centre. Now, the Lexicon Centre was complete in 2018, and it has, I think, the largest Waitrose. It's either the largest Waitrose or M&S, Andy might remember, in the UK. It's one or the other. It has an Armani, L'Occitane, Phoenix. It's the higher end of the market in terms of what I mentioned, fitting in with that sort of demographic that surrounds Bracknell. That's the image that they're going for. But what does it provide? It provides amenity. You have bars, restaurants, cinema, shops, all of this spanning area that provides Bracknell with the opportunity to not just be a place that people can work at some of the biggest companies in the world, but they can also live there because you have access to all of this great lifestyle and amenity on your doorstep. So this was a massive sign of intent from Bracknell. It's the start of their regeneration. And to give you an idea of exposure, in 2019, 6 million people walked through that shopping centre. That's a lot of people and a lot of exposure. So obviously 2020, funny year, but as we get back to some sort of normality, that will continue because of the quality and the amenity that it provides. Next slide. Thank you. This is really important, and we look at sort of where we are investing in Bracknell and what sort of where is it in its in the sort of journey of regeneration. So where you see it say now, with that grey area there, that grey area is what I've just shown you, the Lexicon, the new shopping centre. But what you'll see is over the next sort of 11, 12 years, the town is expanding with this £770 million worth of regeneration. Infrastructure wise, aesthetic wise, the whole town is reshaping. So it's a great time in terms of what we're doing as a developer to buy a site, because we know that as the town expands and as it matures and as it changes, the demand is going to go up. And what happens when the demand goes up? The prices go up. So not only that, but because we've got in there early, you'll see that this blue square is one of the sites that we've bought there. It's right in the center of the town. It's staring at that Lexicon Centre. It's right next to the train station. So you're in pole position ahead of the competition. And as I say, over the next 12 years, other developers are going to come to the market, but we will have beat them to it in terms of our location and what we can provide. So really important. You're buying at a time where obviously the town is going to be changing drastically over the next 12 years. Next slide, please. Again, just sort of off the back of that, you know, the projections from the PLCs that Andy talks about, JLL and Knight Frank and Savills, are all very positive about, you know, where the prices are going to go in Bracknell based on, you know, what we've just talked about, the commercial commitment, the regeneration. And so what you're going to find inevitably is the fact that your properties are going to rent very quickly, you know, when there's that big demand from the people working in these offices, and because Bracknell's becoming on the map. You know, this demand heightens, tenant demand heightens, and that obviously pushes your rental prices up and the value of the property up. So it's it's a really exciting time for Bracknell, which is why, as I mentioned, we've actually committed there twice, which is a big statement from us as a developer as well, because we believe in the market that much. Next question, please.
Next question. There was a question actually, but I think you answered it in, I think you meant slide, but I'm going to come in with Keith asked another question. But I think you answered your last slide about population growth and what's happening. Oh, he's actually said, question, next slide, please.
Next slide. Right. So that's Bracknell. And now about the actual project itself. So as I mentioned, we've got two. The one I'm going to focus on is the Grand Exchange. So this development is 2 years away from completion. We've broken ground, but as I say, it completes in Q1 of 2023. This will be our flagship development in terms of what we've built so far for SevenCapital. And the reason it will be our flagship development is because of the quality of what we're building. So you can see a few CGIs here in front of you. And obviously, if you want more information, we can send it over. But whenever we build a development in any given area, obviously you need to look at who you're building for, who is going to be the person living in this apartment. And what we did with Bracknell is obviously do our due diligence and do our research into that and speak to the local agents. Who are the people that come into your shops and say, I want to rent a 1-bed? And inevitably, these are the people working in the tech industry. So what we knew from our research was that people working in that industry wanted to be in a position where they could work from home, but they were also near to their head office. So we wanted to build something that was in line with the way that the UK market is going, which is about lifestyle and about amenities within your development. You know, that's what people want these days. You know, fast forward a few months from when we decided this, COVID came about, and inevitably now whenever we go back to this new normal, whatever it is, I think we're all in agreement that we're going to be working from home a lot more than we used to, whether it's 1 day a week, 2 days a week. So it's fitted in very nicely with the way that the world is now, because what we have within the Grand Exchange in terms of amenities are, as you see there, there's a gym, there's actually a spa room as well, there's a private dining area within the development, there's a residence lounge, and the big one is there's a co-working space. So within your development, rather than doing what we've all been doing and sitting at your kitchen table doing your work, you can get in the lift, go downstairs, and you have a fully functional workspace within your development. So this is unheard of in the UK. It doesn't exist. And if you wanted to buy a project with this kind of amenity, 24-hour concierge, 24-hour security, spa rooms, gym, everything, you'd be looking in central London and you're paying way over £1 million. But where we're building, obviously in Bracknell, you're paying £290,000 for a 1-bed. So we talk about this as not just our flagship development and the best development in Bracknell, but this is going to be the best development in all of the surrounding areas because of the amenity that it offers and its innovation in terms of a development, because it doesn't exist in the UK. So we're really excited about this. As I say, it's a mix of studios, 1-beds, 2-beds. It completes in 2 years. And yeah, it offers something that we've never offered before, but the UK market hasn't seen before at this level. Next slide, please. Look, in terms of the way that we obviously position our properties, this is something I won't go into too much detail with now, and it can be chopped and changed in terms of the figures that you're inputting. But if you see just quickly on here, this is with an example of a 1-bedroom apartment in the Grand Exchange using an interest-only mortgage, which Andy talked about, 75% mortgage, all of these that you can change. But what it does is it shows you your cash position over 5 years, 10 years, 15 years. And these are the kind of timescales you should be looking at. As Andy mentioned again, you shouldn't be looking at this as, oh, I'm in and out in 2 years. That's not the way to position it. You should be looking at it over the 5, 10, 15-year period. And that's what this illustration allows us to do. And obviously we can send this with relevance to the individual based on loan amounts and interest rates and everything like that. So they're a useful tool. So rather than, the pretty pictures of the property, this is why you're investing. So we make it as sort of easy as possible. And the data that we use, as you see on the left, it's not from SevenCapital making this data up. It's from the big PLCs. This is from JLL as an example, and we use their projections for all of our data. So again, for any sort of extra information or any demands for these illustrations, just ask and we can send them over. Next slide, please. I think that might be it.
I think that's it. Yeah.
That's it. Thank you very much.
Thank you, Johnny. That was brilliant. If I can just go back to the cash flow, not on the screen, but you put 75-25. Somebody's asked the question, is that realistic at the time? I must say, I tend to use 65-35. I don't know if you'd agree.
Yeah, that cash flow tool is interactive. You can change the different boxes. Right now, the UK, if you live in the UK, people are getting about 70 to 75%. But if you're an expat abroad or international, it's more like 60 or 65. And so
I prefer to do that. And the other thing that always comes up, are there any hidden fees, anything you're going to hit with? And I think the great thing about that cash flow, the cash flows we do, is that it's going to be about 8% all said and done, and we've got all the changes of stamp duty, and that's all worked out on the cash flows. But and that is paid on completion. That's another thing that's important for people to know. Those solicitors' fees, etc., apart from exchange of contracts, happens then. So it's worth using those cash flows and get familiar with it. And I know I'm talking to the converted over there, but to our guests online, please get used to using those cash flows. Yeah, Andy, you were going to say something.
I was just going to say, Chris, of course, if you're buying off the timing again, if you're buying off plan, we've just said what the mortgage market is like today, how much you can borrow. But if you're buying something today, like the Grand Exchange, for example, it's not ready until this time in 2 years' time. And so we could see a very different mortgage market there. We could see the pandemic continues and it hasn't gone in 2 years' time, and the lenders are still cautious, and we've still got 60-65% lending. But it could be that we've got past the pandemic, the vaccines have worked, the economy's booming, and it's all very competitive out there, and you're up to 75% or more. And so this is just a snapshot of if you completed today.
That's a good question. Just touching on what you just said, how far behind due to COVID are you on the Grand Exchange? Is that a fair question to ask?
Yeah, it is. I think it was about 4 months, Chris. We broke ground. We're kind of well on the way in the foundations now. We've got the master crane. You have to build a big base, a concrete base. That's up, and so the whole thing's moving. But it didn't start moving until February, when we really wanted to get in November. So we probably had a 3 months delay, but we can catch that up. It's a standard. It's a 2-year build. We said it was going to be Q1, January, February, March in 23, and we'll try and we want to get it finished as quickly as possible. Every development, because the longer it goes, the more staff, the more security, the more insurance. Your appraisal as a developer shrinks the longer it goes. So without cutting corners, we always want to get it done as soon as possible.
I'm going to be a bit naughty here. But we've got some good people on board listening and watching this. Johnny, what else have you got in the pipeline, or whatever you've got? I know you haven't got slides there, but maybe you can mention a couple of other projects that you've got at the moment. Have I thrown you under the bus?
No, not at all. And Andy might be able to answer it slightly better than I am. But look, the areas of focus are going to remain consistent. We want to focus back into Birmingham as well, the city centre sort of Birmingham stock, as well as continuing on the commuter belt side of things. So am I right in saying that, Andy, we're going to have that coming up?
Yeah, we've got going forward, we want to invest, like the Grand Exchange, properties with amenities, because this is what the tenants want. The young professionals, they don't just want to walk in the door and it's their apartment. They want hotel style lobbies and concierge, and they want spas and all of that kind of stuff. They want to work from home. They don't want to work from their apartment. They want a big co-working space with all the facilities and all the rest of it. So that's what we're looking to invest in going forward. Our main areas are going to be Birmingham Town Centre, the key sites, and also London, the commuter belt London, like Bracknell. So yeah, we've got 2,000 apartments in the pipeline, but they won't come to the market for another year. This is in Birmingham, and we're busy buying more. Right, let's have a look. We've got another couple of questions. I mean, we've got ones to go through on the slide. I'm just conscious of time. The questions that have come in live, somebody anonymous attendee, I've been answering the door, the doorbell keeps going and the phone calls, so I've missed half of it. Can you send me a recording? Of course we can, we've got it all recorded. Right, Keith again. Keith, you've sent in 3 questions. Thank you so much for the part you've played today. So a client pay a reservation fee and would have 2 years to pay the balance of the deposit. Well, no, what you do is you put your reservation fee down, and then within a month or two, you put 20% deposit down. So if it's a £200,000 apartment, you put 40,000 down, and then you've got 2 years to get the balance, which most of it will mainly be a mortgage if you're having a mortgage, and pay at the end. But that cash flow forecast that Johnny told you tells you everything that you've got to pay within reason, no surprises. So the stamp duty, etc. In fact, today is a significant day, the 1st of April, because if you're not resident in the UK, from today, you pay an extra 2% stamp duty. For a £300,000 apartment in the UK, the stamp duty on average was 5%, and the government have now put that up to 7%. So you're paying, an extra £6,000 from today on completions. Completions means when we're finished and when we hand it over and you pay in full. So yeah, why have they done that? Well, they know they'll stand it. If you're buying something for 300,000 that in 15 years' time is going to be worth 600,000, who's bothered about 15 or 20,000? And that's why they've done it. But it's just another tax that we've got to suffer, unfortunately. So yeah, on average, if you buy a 300 grand apartment, you're now going to pay 7% instead of 5%. But we'll do some more stuff on that. We work with the tax company BDO, and we'll get them on one of the future webinars to make a simple presentation, make it really easy for people to understand. Should we do some of the questions?
Well, we've got some more.
Well, no, right. Have we got some more?
Yeah.
No, I thought
there's one about if an investor got rejection on a mortgage for any reason, is it possible to sell his unit pre-completion?
Go on, Johnny, you do this one.
So with all of our contracts, they're fully assignable. And what that means is traditionally when you buy a property off plan, you exchange contracts, the contracts are unassignable. What that means is that you have an 80% balance. If you can't get a mortgage or you can't fulfill the 80% with cash, then you lose your 20%. They're unassignable contracts. With all of our contracts, they are fully assignable, which means that from the moment that you pay the 20% deposit, you can assign that contract to somebody else. You can essentially sell it to somebody else. The difficulty is obviously the closer you get to completion, we need people to complete on the property. So if you're doing a mortgage 6 months before completion, which is when you would tend to start it, the closer it gets to completion, you would need to be finding a cash buyer to take that property off your hands. If it was before that and you said, right, I need to assign it well in advance, then there's obviously a chance that you could still sell to another mortgage buyer. But if it is the closer it's getting to completion, you can assign it, you can sell it, but it would need to be done to a cash buyer. We have examples of that happening now, with the world that we're in at the moment. People have lost their jobs and people have had to assign their contracts and they're able to do so. But as I say, your pool is slightly limited because more often than not, you're going to have to find a cash buyer.
Okay, we've been 52 minutes, so let's just whiz through. We've got about another 9 questions here. Let's whiz through them. So, some of them we've already answered. Nanetta, thank you for sending this in. I have one mortgage-free property that I rent out. How can I purchase another property? Well, you can remortgage, Nanetta. You can talk to a mortgage broker and he will tell you how much of that unencumbered property with no debt on it that you can release. You'll then start paying a mortgage on that, but hopefully if you've rented it, it'll cover that. And then you can use that money to go as a deposit for a new property. Right, who's this come up from the bottom now? This is from Catrick Son. Thank you, Catrick. When does a client have to apply for a mortgage for off-plan and for ready properties, before or after down payment? Well, if you're off-plan, it's ready in, say, 1 or 2 years' time. So you put your down payment down now, and then, as Johnny just said, 6 months before, we contact you, we say, right, we're going to be ready. Let's just say we're today, 1st of April, we're going to be ready in September, October. So if you're going to get a mortgage, let's start to think about that now. Who are you going to go with? We recommend these people. And we just got a strong customer service that help you prepare to get your mortgage. You should allow 2 months to 3 months for a mortgage process to go through and the money's ready. So you can get, and then once you've got a mortgage, they'll hold it you for 3 months or sometimes 6 months. And so you've got it, you're all ready, you're ready to go. And when we say we're ready now, you can complete. We make it, it happens every day. Thousands, tens of thousands of people every day complete on off-plan property in the UK. And we're experts at it. That we are experts at, and we'll help you through.
I think it's worth mentioning on that given the fact that the way that the mortgage market is at the moment, because of the way that the world is, a lot of our clients are looking at off-plan property. They don't want to wait 2 years to invest. They want to invest now. But bearing in mind that if you're buying a property that completes in 2 years, your mortgage offers and the options that you have available to you are going to be very different in 2 years' time to what they are now. And when I say different, I mean better. Everyone within the industry is projecting that the options for overseas lenders will be a lot better then. So it is something to consider when buying property now. Perhaps looking at the off-plan option is a better call.
You're right, Johnny. In all my experience, even the financial crash of 2008, I've never seen the off-plan buy-to-let mortgage market as contracted as it is now. They want to lend, but they're risk averse and they're lowering the amount you can lend and putting the interest rates up. Now is not an ideal time to complete. But who knows, it's just the luck of the draw. The timing comes with you and goes against you. Hopefully people completing now will be able to remortgage and get a better deal going forward if they want one. Right, we better crack on with these other questions. Can we have the next one, please, Chloe? Lovish, what a lovely name. Thank you for sending this in. How do I build a portfolio of properties that can guarantee return on investment? And how do I find the right location in UK? That word guarantee is a strong one, Lovish. I don't know how you can guarantee because I told you earlier, you can't get guarantees these days. We're not in traditional buying that we do, because the banks won't give you a mortgage. But if you choose the right, if you look at all the data, everything that Johnny talked about earlier, you know, regeneration, town or city, where there's job creation and a new shopping centre and all of that, and people pouring in to live there. Do your research, speak to the local agents. That's your best way. And then you buy a lovely apartment with all the amenities. So it's future proofed. It's not just open the door and you're in your apartment. There's concierge, and there's a communal dining room, or there's a communal residence lounge, and there's an app and services. This is the future. This is what the young professionals don't mind giving you their £1,000 a month or more, but they know their worth and they want the amenities. They don't just want a horrible apartment. Right, next one. Do you want to do this one, Johnny?
Okay, look, London, Manchester, and Birmingham is still a place for investment. Yeah, thanks, Doris. I think we've, we sort of touched on that. The areas that we're focusing on are going to be the London commuter belt areas and city centre Birmingham. I mean, these are the areas that we're focusing on. I mean, obviously, there's plenty of good investment spots within the UK, but it's about timing the market in the sense of oversupply. One thing that we found with Manchester is that there've been a lot of developers there. It's a great investment spot, but there's 14, 15 different developers that are supplying that market. Whereas we want to look at areas where it isn't so oversupplied, where we're at the sort of beginning of the regeneration or investment within that area. That's what we did with Birmingham initially, and that's what we're doing with the commuter areas of London. So, as I say, you know, there are various places to invest in the UK that are going to be great investments. You know, the UK generically as a market is a great place for investment, but it's about partnering with the right developer, that the quality of the product that you're buying in that area is going to be suitable and rentable and consistently rentable, but also that you're paying the right price.
I would agree with that, Johnny. Doris, a great question and a difficult one to answer, but let me just tell you, all of the new stock that we are buying at SevenCapital are in Birmingham and commuter belt London, because we feel, we've done our research and we feel that there's been oversupply in Manchester, Liverpool and some of the other first cities. We still think there's a long way to go in the Birmingham development story. There's still HS2, there's still Birmingham Smithfield and so on and so forth. So we think there's another 7 years of growth in Birmingham, but we think those other first cities have peaked. Right, but it's just our opinion. Next one. No, I can answer this one. Are HMOs the best way to maximize returns? Thanks, Belginder. Right, what's an HMO? What is it? A multiple occupancy? What is it? Housing. Anyway, it's where you buy a house, convert all the dining room, the living room into bedrooms, so you can get, say you buy a 4-bedroom house, but it's got 3 lounges and kitchen. You turn them all into, you maximize your income. Now, I did this in my 30-odd years of investing. I did it myself because I thought, oh, that's good. I could get 7 tenants into that 4-bedroom house and get all that rent. Well, I couldn't wait to sell it. I kept it for about 9 months and I did get all the rent, but the hassle, I can't tell you what the hassle was like. My wife was an air stewardess, and so we got access to stewardesses and stewards, people from Ireland working out of Birmingham and needing somewhere to live. So we put it up on the notice board, rooms to rent in her crew room. So we got an access to tenants, quality tenants, people with good jobs and et cetera, et cetera. But the trouble, the bickering, she said this, he said that, and so on and so forth, and the late night and the noise, they're playing music and all the rest of it. And it was an absolute disaster. On paper, Belginder, it looks fantastic, but the reality of managing it, it ruined my life. I gave it to an agent and they said, you're not paying me enough. I need to charge 20% to do this because it's hassle. And they come and go, come and go, come and go. If you buy a quality apartment in a town centre and you get a management, middle management, tenant or young professional, they're paying all the money, they're there for a year or two, it's just so much easier. And you've got a long-term plan. So HMOs are popular, but you have to put your heart and soul into it. Okay, next one. What's the best way to scale my property portfolio? Johnny?
I guess obviously what Andy talked about in terms of the idea of, you know, leveraging and interest only mortgages and how you sort of position that in terms of a cash flow perspective, I'd say is probably the best way to look at it. Andy mentioned the example of, you know, buying properties, paying off the leverage, and then in 20 years time or however long you have unencumbered portfolio that's providing you this income. You know, we talk about pension planning being the sort of end goal. And for me personally, that's what I want to achieve, is buy a portfolio of properties, pay off my my mortgage, and then have something that's providing me this income in the future. So I think, yeah, in terms of scaling your portfolio, I think leverage needs to be a big part of that.
Beautiful. Next one, we've got 4 more to go, guys. I'm looking at the participants. Everyone stayed on. Thank you so much for listening to us. Right. Thanks, Tony. And thank you, Christian, for the one before. Do we need more new build homes? Absolutely. Every government in the UK for the last 30 or 40 years has been criticised for not meeting the demand. At the moment, they've just changed it. It was 290,000. They've changed it to 350,000 new homes required every year to be built in the UK to meet the growing demand. And we just can't build them quick enough. And so the governments have changed the planning rules, and they're just trying. A lot of developers will buy the land and sit on it because it's strategic. They bought that much land. We'll build this now, but we're going to keep that for 10 years because we'll get a bit better return on it. Well, that's no good, because people need places to live. But in general, it's about supply and demand in the city centres and the town centres where the young professionals want to live, work and play. That's where your best places are to invest in off-plan property that's hands off, fully managed. That's what you want. All you people who are watching this today, you hopefully got yourself into a financial position where you can invest, but you're busy. You're busy people. You don't want to be doing it yourself unless you're retired. You know, if you've got a career, you just need all this doing for you. And that's what we specialize in. Right, next one. Go on, Johnny. Good luck with that one.
How the new tax laws attract investors to invest in the UK. How they attract, I mean, I think this maybe was referring to the stamp duty holiday, which has ended, but, you know, ended yesterday, but then obviously goes on till June the 3rd, but with the added 2% that Andy talked about earlier. Look, I think taking sort of tax out of it, the UK is always going to be an attractive place to invest. The tax payment that you pay is a one-off payment on completion of a property. So this stamp duty, whether it's £10,000 or £15,000, that shouldn't be too much in your train of thought. We talked about this being a 10, 15, 20-year vision that you have for your investment. The stamp duty isn't a payment that you pay, or the tax isn't a payment that you pay every year. It's a payment that you pay one-off on completion. So it should be thought of in that way and looked at in the long term. So every country has these tax laws or these stamp duty laws that you pay on completion. You know, Canada's up to 15%. Germany's even more than we are. So is that a reason, you know, the stamp duty holiday? Yes, it's attracted investors to invest in the UK again, but that's always going to be the case. The UK is always going to be an attractive market because the fundamentals are incredibly strong. The supply and demand imbalance is huge. As Andy's just mentioned, we don't have enough properties. What does that mean? It means that properties rent incredibly quickly, they rent consistently, and that's what investors want. So yeah, I think, as I say, that you're asking about the attraction. So I imagine it's referring to the stamp duty holiday, and that did see, you know, an increase investment into the UK, but I don't think it's going to change anything in the long run.
Thanks, Johnny. And thanks, Hamed, for that really good question. Look, tax is a really important part for all of us in all of our income, and in particular with our property. We've got to understand it. We've got to make sure we go in with our eyes open. SevenCapital, we're developers. We're not advisors. We can't give you advice on tax or wealth management. That's Holborn. But what we can do is we partner with an international tax firm called BDO. And we're going to do another seminar where they present with us to make tax really simple so that it answers all your questions. The main tax is obviously stamp duty when you buy, and also tax on income, your rental income as you go along, and on your exit. What happens when I sell? How much tax will I pay? And so they are great questions, and we will be doing a separate one on that. Thanks, Hamid. Next one, please, Chloe. I think there's 2 or 3 left. Cheyenne, thank you for this. Working remotely, need to live in London like they want. Okay, yeah. Where do you see the London property market focus? Well, look, like I said, the PLCs are now saying they're seeing a demand of people going for their home counties, the commuter belt around London. Why do I want to pay £3,000 and live in Canary Wharf, where I can pay 1,500 quid and live 10 minutes away? How long there is definitely an upsurge in that. This is what we're getting right now. How long will it last? What's the legacy after COVID? Will it last forever? Will everybody now start working from home? My personal view is I think there'll be a residual legacy of about 20%. I think, yeah, look, we could talk about this till the cows come home. Who knows? But yeah, we are seeing right now more of a demand for commuter belt London than London itself. But look, you never write London off. It's about supply and demand, as Johnny said. There's a finite amount of properties in London and the whole world wants a piece of it. So historically, it's performed fantastically. It's just so high. That's the trouble. If you want to get in London now, you're talking minimum 500,000, million, 5, 10 million. A lot of people are at the 50k price point. I can buy a 250 grand apartment because I want to put 50k down. I don't want to put 500,000 down. So yeah, who knows, Cheyenne? Thank you. Next one. Our apartment's better than houses from a buy-to-let perspective. Well, we talked about that, didn't we? You got to think about your tenant. One thing that I thought about, Vij, thank you for your question, is often with apartments in city centres, people get a job for a year or two and they move on. What's attractive about in the suburbs houses, you get a family that move in and they stay for 5 years. They're called a static tenant instead of a transient tenant. A transient tenant is, I'm from Newcastle, got a job in Birmingham, I'm there for 2 years and then I'm off. A static tenant is, I'm from a suburb in Birmingham, my parents are from here, I'm from here, all my friends and family from here. I'm not going anywhere. I just want, and I'm going to stay in this house for 5 years or more, and I'm going to treat it like my own. I'm not going to ring the landlord every time the painting falls off the wall. I'm going to do it myself. And so that's quite attractive. The difference is with this culture change now is that the city centres and the town centres aren't just transient tenants who are coming in for work. It's also people are now moving to the city centres because of the bars and the restaurants and the leisure and the work, rest and play. And so, and there are green spaces and they're increasing schools for the kids and all the rest of it because the city centres and the towns are getting bigger and bigger. As young millennials from 20 to kind of 35, there's a huge demand for people wanting to live in the town centre. So look, you set your stall out. We're specialised in off-plan property in city centres and town centres. But by all means, have a look. Speak to letting agents and estate agents. Have a look at a more, suburb area. Right, next one. Oh, that's it.
Thank you, Andy. Brilliant. No more questions to go. Thank you, Johnny. That was really, really good. And the fact is that so many people stayed on for so long is testament to that. So thank you very much. So thank you for all those that jumped on, the Holborn consultants and their clients. And if you want information, obviously you can go direct to Johnny. You can go to Elliot, whoever it is in the world where you are, Andy, and of course myself. And I can put you onto the right person. But thank you, guys. Really enjoyed that. Always entertaining. And can't wait to the next one with your tax man. We've also got a tax man where you deal with, by the way, I might add.
Brilliant. Chris, it goes without saying that we're always so proud to partner with a brand like Holborn and you guys. It's been a great partnership and long may it continue. And we love you as well, Chris. So thanks for putting this together.